Hi, welcome to the first of our series in lectures by Prosperity Lounge. Today we're going to be doing what I like to call Demystifying Deferred Tax. Deferred tax is probably one of the hardest sections that one has to get to grasp with at university. And what we'd like to do today is just basically explain the basics behind understanding deferred tax and why we actually do it. There are two basic approaches to understanding deferred tax. The first that I'd like to teach you is what I like to call the net asset value approach. Now, what one has to understand when I teach you these two approaches is that neither of these approaches are conventional approaches for understanding, and one cannot use these for explaining deferred tax in an exam, but they are nice ways for understanding deferred tax. The first, as I said, the net asset value approach. Let's assume a person invests 100,000 Rand in the business and uses that to buy a machine. We now have a business with a machine, let's call it a shoemaking machine. Our business looks in essence like this. We have PPE worth 100,000 Rand, and we have the equivalent equity worth 100,000 Rand. What we are saying when we capitalize a machine to the balance sheet of 100,000 Rand is that the present value of the future profits of this machine is going to be 100,000 Rand. Now, that is not 100% correct from an accounting theory point of view, for as we know, when a business makes profits, some of that is going to have to be shared with the receiver of revenue, as we know it in the South African context, the South African Revenue Services. What we do to account for that, we put through a journal called deferred tax. Let's assume for ease of calculation purposes that would be we use a rate of 30%. We would then enter a journal that looks something like this. Debit. Deferred tax income statement, 30,000 Rand, and we credit deferred tax balance sheet 30,000 Rand. As being a liability owing to SARS in the future of 30,000 Rand. When we actually make these profits of 100,000 Rand, we will pay 30,000 Rand in profits. If we now re-look at our balance sheet, we now have a balance sheet that looks in essence like this. PPE, 100,000 Rand. Equity of 70,000 Rand, being our original 100,000 Rand, less the 30,000 Rand charged to the income statement. And a liability for deferred tax of 30,000 Rand. And our net asset value more accurately, correctly reflects what this business is actually worth, being that the present value of the profits that this machine will generate is actually 100,000 less the 30,000 Rand tax that this business is going to generate, and we have an actual net asset value of the business being 70,000 Rand. Now, again, if we look at the scenario, that again is not actually correct, because what is going to happen is that this business is actually going to have what we like to call wear and tear as should I say, protected profits or deduction. Now all of us who have done deferred tax at university will be used to this table. Our carrying value on the PPE, 100,000, as we said. The present value of the profits that we're going to earn from this machine being 100,000 from the manufacturer of the shoes. Our tax base. Well, how much of these profits are going to be protected? Well, assume that SARS is going to give us the full wear and tear, being, let's call it 100,000 Rand at the beginning of time 0. Our temporary difference is therefore 0, and deferred tax is actually correctly now reflected at 0. If we then had to go and redo our balance sheet, we therefore don't need to actually put the deferred tax entry that we did originally, and our balance sheet correctly reflects PPE of 100,000 Rand and equity of 100,000 Rand. And that's assuming, of course, that we were given the wear and tear allowance against the machine. If, of course, we were not given those deductions, we would have had the case, we would have to account for tax against those future profits. Now, as mentioned, there is a second method. The second method is what I like to call the income smoothing method. Now, this is a far more unorthodox method of understanding deferred tax to the first method. This method occurs in certain examples where we have things like revenue received in advance. And specifically, as an example would work, let's look at this example. Let's assume we have revenue received in advance also of 100,000 Rand. What happens? We pass an entry that looks like this. Debit, bank, 100,000 Rand, credit, rev received in advance 100,000 Rand, being in essence a current liability. If we take a look at our income statement, what happens in this? What does the scenario look like? We have an income statement that looks like this. Revenue, 0. Profits, 0. Assuming, of course, this is the only transaction that happened in this business. Tax. Now, assume from SARS's perspective that we had unconditional entitlement to this money. We would therefore get taxed on this income. Assume again that this income was taxed at 30% for ease of calculation, and you'd have a tax charge of 30,000 Rand being placed to these books. You'd have a profit after tax of, or should I say a loss after tax of 30,000 Rand. Now, an investor who would look at this business would find this a very strange business. You have no income, no profits, but tax. What happens now is, as I say, we have deferred tax that comes along and smooths out the income. or smooths out the tax, should I say, and makes his business look more correct. Let's have a look at it now after deferred tax is placed through. We go ahead and we move the tax charge from one year to the next. We place through a journal entry that looks something like this. We say to ourselves, well, when we actually recognize the revenue on this from an accounting perspective, we're not going to pay tax on it. So in essence, as far as we're concerned, we have like a little bit of an asset because it's income that's not going to be taxed. So we recognize what we call a deferred tax asset. So we would pass a journal that looks something like this. Debit, deferred tax balance sheet, 30,000 Rand, and credit, deferred tax income statement, 30,000 Rand. If we re-look at the scenario of our income statement, we have a scenario that looks something like this. Revenue, 0. Profits, 0. Normal tax, 30,000 Rand. Deferred tax, 30,000 Rand being a credit. And our profit after tax, 0. An investor looking at these statements would be far more comfortable. See, 0 profits, 0 tax being the netted off tax, and a 0 profit after tax. Now let's forward on to year 2. What happens in year 2? Year 2, we now go ahead and recognize this income. What is the journal we pass, of course? Debit the rev received in advance being the 100,000 Rand. We credit actual revenue in the income statement being 100,000 Rand. Our profits are now 100,000 Rand, assuming no other income and expenses. Normal tax is now 0, but we now have this deferred tax asset which no longer existed. So what do we do? Well, the easy side of the entry, of course, is to credit the deferred tax asset, being the balance sheet, with 30,000 Rand. And we debit deferred tax income statement, 30,000 Rand. What happens here? We show a beautiful profit of 70,000 Rand after tax. If we had to do what's the effective tax rate, it is 30%, 0%, and our income has been beautifully smoothed out as per income smoothing approach. I hope you have found this lecture interesting and both helpful. If you'd like to find out more about the business, you can visit us on www.prosperitylounge.co.za, where I have notes on this actual topic that you can download, as well on other courses such as the intricacies of intercompany journals and getting to grip with basics. I'll be on a weekly basis uploading more YouTube videos and clips. If you would like to suggest any clips that you'd like me to film and other articles you'd like me to write, please feel free to email me. You can register on the site for free. I also offer corporate training for those of you who have companies and they would like me to actually design some courses for you. I thank you very much for taking the time to watch this clip. Be well.